Welcome to another weekly Southbank bulletin, and I thought I'd pick up the economic calendar just to start off this week. So you can see that Lloyd's business barometer will be out on the 30th, and then we'll also have the nationwide house price index, and you can see that the survey is for on the monthly to be down about 0.5%, but year over year to be up about 1.8%. So the the reading of house price growth is declining on a year-over-year basis, and on a month-over-month basis, it's also the expectation is that the speed of the decline will continue. And then, of course, we're going to have the Bank of England. Now, that's on the 2nd of February, and they're expected to raise rates by 50 basis points. Now, if we then look at the United States, then we're going to be just paying attention to the fact that the Fed funds rate will probably go up by 1/4 of a basis point on the 1st of February. So that's going to then raise an important question. And let's just first think about Wall Street. There is a great deal of enthusiasm right now around artificial intelligence. It's not like we haven't had artificial intelligence on the menu previously. In fact, there have been plenty of opportunities to invest in artificial intelligence over the last decade, but ChatGPT has certainly reignited those interests. Now, the S&P 500 is right back in the region of the peak from all the way back in early December. And I know it's only about 6 weeks ago, but it feels like an eternity. Now, we've had an important low in October, and this is where the really big argument is. Is this the low, or is it a low? And we've certainly seen a loss of downside momentum. Prices right now are more or less where they were all the way back in May of last year. So then it begs the question, have we seen the worst of the selling, or is there worse to come? Well, I think a lot is going to depend on what the Federal Reserve does. If they decide they're going to stop raising rates soon, and then ultimately start cutting rates before the end of the year, that will greatly enhance the potential that this is a soft landing. And that would be a green light for more speculative activity. On the other hand, if they decide that they're not going to stop raising rates, but instead that they're going to keep raising rates, just not as quickly, in other words, they've come down from 75 basis points to 50 basis point hikes, and the wide expectation is that they're going to go down to 25 basis points on the 1st of February. The market has rebounded on the expectation that the hike on February 1st will probably be the last hike in this cycle, and that subsequently rates are going to come back down, inflation is going to moderate, and unemployment will not spike. That is the trifecta of conditions for a soft landing. On the other hand, we definitely have more speculative activity going on right now, and there's a lot of liquidity still floating around. That is despite the fact that we have inverted yield curves. So when we start to think then about how likely is that soft landing, well, a lot has to go right. And I suspect that there's the potential for quite a bit of volatility between now and then. But then let's just measure some of that volatility. So the VIX index is in negative territory again today, and it has now broken the sequence of lower rally highs, of higher reaction lows. There's been this very clear downward bias since the beginning of 2022. There has been an upward bias since the middle of 2021, but now we're breaking down into new low territory, and that is very much indicative of a risk-on behavior. Now, this is a different way of measuring volatility. It's for bonds instead of equities, and we can see that bond volatility is now also starting to break lower. And there's been a lot of fear about the bond markets. and we had a really significant spike in bonds all the way up to test the peaks from 2020, right at the end of last year. So that would suggest that we're seeing more demand for bonds as well, and more demand for bonds should contract yields. Now let's think about the UK. Well, the pound is reasonably steady, holding around the 123.9 area, holding the move above 120. It's up inside the overhead trading range, which really proceeded from 2015 through to about the middle of 2022. And we're pushing back up into it right now. One of the primary reasons why the dollar was so strong in 21 and 22 was because the Federal Reserve was raising rates so aggressively. Whereas what we're now seeing is that the Fed is slowing down and the Bank of England is actually raising rates faster than the USA. So that's supporting the currency. And then we have the additional fact that the FTSE 250 sold off aggressively and has now broken the sequence of lower rally highs, and it's continuing to stabilize. Then let's think about the banking sector. One of the characteristics of the European banks was that because of the war in Ukraine, they were really worried about the prospect of a major recession in the winter of 22 and 23. But that then forced those banks, I apologize for my phone, that forced those banks to then put money aside, and those are called loan loss provisions. So now when a recession has largely been avoided, and of course it was avoided because governments spent an absolute ton of money on buying natural gas, and natural gas inventories right now are at the highest level for this time in the winter in history. So the mild weather has ensured that we're not going to have the energy crisis in the winter this year. It means that the loan loss provisions that were set aside by the banks can be brought back on the balance sheet. So we're seeing European banks popping on the upside, or UK banks popping on the upside, and also European banks doing the same thing. So this is certainly also positive because it is freeing up additional liquidity. So we've had tight liquidity conditions right across Europe. Now they're starting to free up, and currencies are appreciating. And then of course you have lower valuations in just about all of Europe relative to the USA. So it is making European assets look much more attractive from the perspective of an international investor. And then let's think about gold, where the price is hovering here below the 2000 level. But then let's also look at it in pounds. And the gold price in pounds is right at the upper side of this range that's been forming now for over 2 years. And we can also think about the fact that every time gold got up to the upper side of this range, it kind of raced to get there. And then we had some consolidations along the way. So it's pausing right now in the region of these peaks, and we might see a little bit of additional pause. But when gold in pounds pops above £1,600, then that is going to be a very significant event. And it's likely to signal the beginning of a major new bull trend overall. We're also way above where the price peaked back in 2011. So this is a significant bull market for gold in pounds, and this still looks like really quite a consistent trend overall. Now let's do the same thing with the oil price. Rather than thinking about it in dollar terms, let's redenominate it into the pound. And because the pound is strengthening, then what this is helping to do is to moderate some of the energy price pressures. So the price right now is also hovering here around the £70 level. That's the upper side of this range, but in negative territory in here today. And it also does help to highlight that the spike that we saw at the beginning of 2022 took us significantly above where prices had been trading in 2008 and all the way through between 2011 and 13. So what happens next in terms of interest rates and the outlook for inflation is going to be particularly pivotal. And I suspect that the information we get from central banks next week is something that's going to inform investor decisions about what to do with one's money, whether to chase this rally or whether to expect additional consolidation. I think with that, I'll leave you for the week and wish all the best to all of you.